Your spouse is your first sale.
I used to say your co-founder is your first sale, but you're right. Your spouse is really your first sale. What I wanted to do didn't exist 4 years ago when I graduated, but now it does. I looked at, I kid you not, over 1,000 startups in a 2-month period. Contracts keep honest people honest. They didn't really help in that case. So we ended up with lawsuits and hurt feelings. Did they not work out for reasons that I could have predicted in advance? Or had I done everything that I could have done? I don't think there's anything else I could have done in this case.
How did that affect the company?
The moment that happened, it died. Experience is what you get when you didn't get what you wanted. It was a hell of an experience. When I first started, there was very little advice. If you could find it, it was actually reasonably good. Now we're drowning in advice, but there's a lot of posers. The hack that I now recommend is a little different.
I'm Jedidiah Weller, and today's guest is Andrew Ackerman, a 2X startup founder, a serial entrepreneur, an investor, and one of the most experienced early stage operators that you'll ever hear from. Andrew has founded and exited from multiple companies and has since invested in over 70 startups. He's the author of The Entrepreneur's Odyssey and now operates as a VC and an SPV syndicate sponsor focused on PropTech and construction technology. So most founders think that the hard part is getting the idea, but in reality, the hard part is surviving the people decisions, the capital decisions, and the mistakes that you don't even know you're making yet. So in this episode, Andrew breaks down what actually happens after the pitch decks and medium posts, from founder breakups to bad contracts to raising money the wrong way. In today's conversation, you'll learn why co-founder dynamics and not product are often what kills startups. You'll learn how investors actually evaluate founders, the financials, and the fundraising strategy. And you'll also learn what over 70 investments teach you about which founders succeed and which ones don't. So if you're building a company, raising capital, or even just considering taking the leap, this episode will save you from mistakes most founders only learn the hard way. This is Jedidiah Weller with Founders Who Build. We hope you enjoyed the episode. Thank you. Hey everyone, this is Jedidiah Weller from Founders Who Build, and I'm super excited to welcome Andrew Ackerman. Andrew is a multiple successful founder. He's invested in over 70 startups. He has been through the gambit, and he is now here today to share with us some of his experiences, some of the knowledge that he's gained, and some of the things to avoid that he's learned through the hard experiences. He also is the author of The Entrepreneur's Odyssey, which is a collection of advice and recommendations from his journey written in story form. So we're going to talk about that a little bit, and we're going to talk about his startups that he created, the process he went through, both in the failures and the successes, and also in the investment side as well. So if you're looking to learn about any of those topics, and this seems to be a good podcast and YouTube video for you to watch. So with that said, let's get a little introduction here from Andrew.
Oh, great. That was an awesome intro. I'm excited to hear from you now.
Yeah, I'm excited too.
So I started off as actually a consultant, right? So when I graduated business school, this whole startup thing wasn't a thing, right? If you said you were an entrepreneur, you were kind of unemployed. So coming out of business school was like door on the right's management consulting, door on the left is iBanking, and I knew I didn't want to do that. So okay, let's be a consultant. Great opportunity.
What type of consulting?
Management consulting, high-level strategy and operations, a company called Booz Allen and Hamilton.
Okay.
So it was great. It was a lot of fun, but it wasn't what I wanted to do. It was a lot of Fortune 100 clients, a lot of hey, you got to move, and then just waiting and waiting and waiting. And then my last project there was actually an intranet project for companies that were merging. And I'm like, wait, that's what I want to do, right? That's really cool. What I wanted to do didn't exist 4 years ago when I graduated, but now it does. So I'm done with consulting. I'm going to go do that thing.
Oh, awesome. And so, okay, so then that thing, did that become your first startup that you created?
Almost, right? So, you have to be a little, there's some things that I've been very lucky about and some things are very purposeful. So in this case, I had to be purposeful. You need to go through a consulting detox. So I switched from consulting to an industry job at Kaplan Test Prep. They were thinking about how do we build out this, this internet thing, right? We have this, this CD-ROM. Remember those, right? Yeah. And we have this in-classroom experience. There's got to be something on this interwebs thing that we can build. So I spent 9 months working for them, building their strategy for transitioning and what they would build and what that would look like. And before the 1 year mark, I managed to connect with 2 guys, one of whom was the brother of a guy I went to business school, who were building what would ultimately become the first startup I founded.
Awesome. Okay. All right. So let's hear about the startup. So what was the first startup that you founded? What was the elevator pitch for it?
It was internet services for summer camps. So
Internet
summer
service.
camps back in 2000, if they had anything, they had a 3-page brochure website, maybe.
Okay.
But at the same time, they had parents saying, "We want photos of our kids. Why can't we see photos of our kids? And we want to get in touch with them because we're used to sending emails, but but we don't want our kids anywhere near a computer." So we started out with two products, a photo gallery and what we call bunk notes, which were password protected ways, safe ways for parents to see photos of their kids and ways for parents to send messages to their kids that would ultimately get printed out and given to them. And then we grew from there.
Okay. And like, where did you take this company to? Like, what was the like? Did you sell it? Did you close
Great,
it?
great question. No. I had an exit. Thank you.
Okay.
It was nice. It wasn't like go home and buy a boat exit, but it was a pretty good exit. So we had taken it about somewhere around the 4 or 5, 6 year mark. It was like, okay, let's try to sell it. And we ultimately brought in a banker to help us do it. He got a valuation I thought was quite fair, given where we were. The founder was like, "Nah, I think it could be bigger." So I turned around to my co-founder. I said, "Ari, like, okay, that's cool, but I've been here a long time. If you think the valuation that the banker got us is a little too low, well, you should be thrilled to buy me out at that price." So ultimately, yeah, I know that was a little bit of jujitsu right there. But after some hemming and hawing, we agreed that I would spend a year finding and training up my replacement, and then the company bought me out. That happened in 2008. So in
Wow.
January 2nd of 2009, I'm getting like the last buyout check from the CEO. And remember, the world had like collapsed at that point. And he has he holding his check. He's like, maybe I should have taken the buyout. But no,
Retrospect, right?
but there's a happy ending, right? So a couple of years later, the company was called Bunk One was acquired by a private equity shop that was doing a bit of a roll up around registration systems because we'd built a whole camp registration system by that point. So ultimately, there was an exit for the company as a whole as well.
Oh, that's awesome. So can you tell us a little bit about, like, I don't know, that exit process or that roll up process? Like, when you guys first started talking to the banks, was it stressful? Like, what was it like for other founders who might be considering that?
Sure. I mean, had we known more about it, it would probably have been more stressful. No. It's like we didn't know anything, right? We didn't know anything. Let me take you back to 2006, right? There are some blogs. That's about it. Like there's like we're used to everything we need to know about building a company in theory being out there on the web. Now, a lot of that information is kind of sometimes sketchy and self-conflicting, but back then there wasn't a lot out there. And if you wanted to go do the exit, you either had a VC that had backed you, working you through that, which we didn't. Right? We didn't have a VC back. That's a separate story. Or you're kind of figuring it out on your own. So I had met a guy from Lawrence Aspitz, great guy. He'd done a lot of M&A work in what we call TNT, technology, media, and telecom. And we met him, good guy. And he's like, "Listen, it's a little smaller than what I normally do, but I think you guys will go on and do a lot of great things. So let me see what I can do." He ran a great process. He got like almost exactly into the strike zone he thought we were going to get into from the beginning. So we called the shot. So it was great, but he walked us through the process, right? I mean, even if you are a successful founder, how many times do you go through an exit process, right?
Yeah, right. And
Right.
how many times do you want to create a company and go through the hell to get to the exit process, right?
I mean, if it ends well, like you get bored. I mean, you're ruined for other work, right? So
Yep.
after a little bit of time just kicking around the house in your socks, you're like, this thing's I think I could do that better. Right. So you're
Yeah.
not going to go back to corporate. Maybe you have like a 2 year earn out when the corporate acquirer bought you, and then like you're dying inside until the 2 years are up. So yeah,
Yeah.
you'll go back. But the truth is, like the bankers, they do this all the time. Your lawyers, they've seen a zillion of these. The VC funds that have backed you, they've seen dozens, if not hundreds of them. So they're really the people who will guide you through the exit process.
Okay, gotcha. And so then tell us about how you went from that exit to your second startup, you know? Like, what made you decide to take that leap? And And what is the second startup?
So remember, I told you there's a mix of like luck and purposefulness. So where I kind of dropped the ball on purposefulness was I was so heads down on like, we got to build a great startup, got to build a great startup, that I hadn't really invested in my personal brand and the network. So as like the dust starts to settle on the, I'm actually going to exit at this point, there was a, oh, holy crap, what am I doing next?
Boom.
So I happened to stumble into the opportunity to run a family office. Now, for those in the audience who don't know what a family office is, it's basically a rich person or a rich family who needs people to invest their money for them, right? And that ranges in sophistication from a guy in a room to like a team of people. Some people do VC, some people do private equity, some people do hedge, other people just, manage donations, right? So I managed to get into that situation. And with the world totally imploding in the end of 2008, having a salary didn't seem like the worst thing out there. So I did that
Yeah.
for 3 years. I learned a lot. Wasn't ultimately a good fit for me, partially due to who I was working with and partially because it was like, you know, I wanted to build stuff again. And then I got recruited to do my second startup, which was a digital memories startup. So, for parents, kind of worked really well with like the stuff I had been doing with camps before, but this was more of a direct to consumer play.
And what was it called?
The second company was called Layer Cake. And if you've
Layer
ever
Cake.
heard the expression, experience is what you get when you didn't get what you wanted, it was a hell of an experience.
Okay. So can you walk us through that in a little bit detail?
Sure. So I'd been approached by a guy who had never built a startup before, had this grand vision for it. And he had spent a bunch of time kind of like banging around trying to get dev shops to work on it without that much success, or I should say, spent a lot of money, but without that much to show for it. And then when we got connected through a mutual acquaintance, he's like, oh, yeah, I need somebody like Andrew to do this. So we spent a bunch of time kind of paring down his grand vision into a series of stages: minimum viable product, build this now. Then we do next, and work our way through that. I recruited a CEO.
And what were you? Sorry, what were you brought on for, or like what
I
did
was
you
brought
join
on
the
to be
team
the,
as?
the CEO and co-founder.
Okay, gotcha. Okay, so you were brought on from the very beginning with an expectation of you're going to be co-running this or leading an initiative. Like I guess I'd like to understand is how did you guys break up the responsibilities?
So that's ultimately where things go off the rails. So the original idea was that we'll call it the idea founder, after having spent a year and a bunch of money like going nowhere and realized he'd come from the restaurant business. After realizing it wasn't in him, he was going to bring in me to run it, and he was going to be essentially a very involved chairman of the board, which is a difficult thing for people who come up with ideas, and even for founders who have taken a company to like a Series B level, and then they realize that like they're not the person to take it to the next level. It's a very mature and difficult thing for a lot of founders to do. But he had come to the conclusion that with him running it, it wasn't going to get off the ground, and if I were running it, that would do it. So I recruited a CTO who was, yes, nominally the third co-founder. He was funding it for the first 6 months. And the idea would be during that time, while Carmen, the CTO, was building, I was out there pre-selling to VCs so that when we had our MVP done in around 6 months, I would be hitting the ground already kind of with the ground prepared to raise. And if you remember 2012, 2013, photo-based startups were really hot back then. And this was digital memories. It was photos, audio, written. It was a whole bunch of things. So the timing was good, and all that was fine. Where things got a little hinky, and it's just something that I anticipated a little bit, was this was the idea founder's first go around. And I knew that having this huge vision that we had kind of boiled down to an MVP for phase one would be very exciting. And he'd start to see things happening and it's like, oh, that's how it works. Awesome. But I also knew that somewhere after like month 2, when you just have to let the CTO work, there was going to be a lull that would be like antsy time. So, I had designed my deal with him such that I wanted to make sure it was economically in everybody's best interest just to let me have those 6 months, not to get antsy and want to change directions. I didn't think it was going to be a big issue, but I had been advised well enough that like that could happen. And it did happen. It's exactly what happened. What was not predicted was that instead of saying, yes, I know the agreement says yes, so it's in my best interest just to keep going with this, he would just say, yeah, so sue me. So contracts keep honest people honest. They didn't really help in that case. So we ended up with lawsuits and hurt feelings and all that fun stuff.
That sucks. And so how did that affect the company?
Company's dead.
Company died. Basically, company died.
The moment that
moment.
happened, it died. Right. The moment you have anything that's that fundamental, like you don't have time in the day for those distractions, and you don't have what do you do? Waste a year? Right. The market moves on.
Yeah. Yeah, you're right. Yeah, opportunities, you need to grab them when they come up. So what would you recommend to, founders, future founders who might be entering into, a contract, like a similar contract? I mean, is there anything that you would recommend to them?
It's tough, right? There's certain things that you look back and you're like, listen, it was worth a roll of the dice. Like, are you a blackjack player?
Occasionally, but not good.
Well, let me ask you, always split. The
Always
phrase,
split?
always split
No,
what?
I don't know the
Oh,
phrase. Yeah.
aces and eights. Always split aces and eights, right? If you're dealt two
Oh,
eights,
okay.
you split them because that's the odds are so much in your favor. And if you have two eights, you always split them. Sometimes you still lose, right? Because there's some odds or random odds in here, but those were always the right strategic move in blackjack. So I look back at a lot of things I do when they don't work out. I try to do this post-mortem. Did they not work out for reasons that I could have predicted in advance? Or had I done everything that I could have done, and this was just the irreducible amount of risk involved? I think in this case, I had done everything that I could. I had worked with this other guy for a period of several months to get to know each other, to get to know the vibe before I had mutual friends with him, or at least mutual acquaintances. I constructed a contract that was very clear with the expectations. We had explicit conversations about it. I don't think there's anything else I could have done in this case. But what I will suggest for founders, since you're on the question of what should founders do, just work with each other for a little bit beforehand. You don't have to paper over everything right away. You can have like a half-page letter of intent level, like, hey, we think we're going to build this. We think we're going to split the equity roughly this way. And then just work together for a month or 2 or 3 to get to feel what it's like to feel with each other. Maybe you have an agreement like, if we split ways, like this IP is mine. Like I'm the programmer. Like if we split ways, you can't keep my code. But that's enough.
Yeah.
It's enough just to get to know each other.
Yeah. It's funny you say that. I had a similar experience. I was co-founders, a 50-50 co-founder at one point of my first agency I ever created. And we hired the attorneys. We got all the ducks in a row, where we had deadlock resolution clauses and all that stuff, right? So everything seemed perfect. But then when we did get to the point where we disagreed, what they don't tell you is that even if you're going to go through these phases, right, that it takes so much time and so much money. And how are you going to operate the business while all that's going on? It's a big emotional toll too. And so I empathize with you, and I agree 100%, that you really need to know the person and have maybe also have a plan for what would it look like in 4 years if the relationship no longer works out. Like, do you guys have a strategy for that?
Well, I'll give you 2 tips, which are run out several years too late, so I apologize.
Okay, no worries.
Are you VC backed on that one? It doesn't sound like it. It sounds like it was
No.
no. So if you were VC backed, they would never have let you do it. They would have insisted on a 51-49 split. All right.
That way there's a clear decision maker, I take it.
Yeah. Or if you had a third person, or something, it would be like 49-49-2, right? So it's very, very clear. We've been down that path before, right? And time kills it, and then it festers, right? So it hurts the relationship. So we would want that done, and we would want that in place beforehand with a very simple, like, hey, he's got 51%. That's a little bit like the nuclear option, because you don't want to run roughshod over, your partner, your co-founder. So it's kind of a worst case scenario, but at least it keeps things moving forward, and you can, if things succeed, you can patch over it. So that's one. The other thing that I've seen founders get tripped up on is not having reverse vesting for co-founders.
Reverse vesting, what is that?
So you can have vesting like the same. Okay, I'll roll it back, right? So when you hire a new person to a company in a startup, they get a certain amount of options typically, and those vest over time. Usually 1 year cliff, meaning they don't get anything until they've been there a year. Then they get 25% of the options vesting. And then either monthly or quarterly, they get a little bit more until they hit the 4 year mark, where all the options they were promised are now theirs. When they are founders rather than employees, usually you do something that's similar but different. You give them the shares outright so that the clock starts on capital gains right away, but it's subject to a reverse vesting agreement, which if they leave, they have to give back a certain amount.
Interesting.
So the economics are the same. It's a little bit semantics. They can vote their shares earlier, and taxes, it's more tax efficient. But the key thing is you can't have somebody leave after 9 months and own 25% of the company. It kills your ability to raise. Like if they leave and you need to replace them, you don't have the equity to give away. So most VCs will insist on reverse vesting to protect yourself. Or by the way, it's not just them leaving. I've had companies where the one of the founders was hit by a truck, literally.
Wow.
This is before I invested, but his co-founder was the CTO, was hit by a truck, and they had reverse vesting. They were okay, but they didn't have shared passwords. All the code was locked, and he couldn't get to it. So he had to recode the entire site.
Wow, that's crazy.
Yeah.
How long? Like, how far did that put them back?
So in a way, it didn't matter to me because I invested after. Sorry, that's a little.
Oh, okay, yeah, no worries.
But no, it set them back about 6 months and a lot of money.
Wow. And 6 months in a startup industry is a ton of time,
It's faster
like you were saying
cycle
earlier.
time because you know what you need to build. There's no dead ends, and you can do certain stuff a little bit more efficiently. So there were silver linings, but it was a pretty bad storm cloud for a while.
Yeah, wow. All right, so you've created these two companies then, right? One exited, one failed, and then you went into the accelerator space afterwards, or did you become an investor afterwards? What was your transition after that?
Sure. So again, this is where like part purposeful, part luck kind of converge. So I had started during my first startup to make a couple of angel investments. And I just got lucky, brutally honest. Like I had stuff that I would never invest in today. I put some money in, I got lucky. But to use another gambling analogy, like if you go in there and you put like a chip down on the roulette wheel and it pays off, you're hooked. So I'd done maybe 5 angel investments over a couple of years. 2 of them had done well. The others, the less said, the better. Actually, funny story. I had a friend of mine who I know socially ask me, "Hey, are you an investor in X?" And it's a company I hadn't thought of in like 15 years. I'm like, "Yeah, how do you know that?" It turned out the founder had died and he was liquidating the estate, and they were trying to figure out if there's any value left in the intellectual property in that startup.
That's too funny. And I take it now when you say X, you actually mean X as a variable and not X, the new Twitter, right?
No, I meant not the new Twitter.
We're going to start using Y now.
Yeah, no. So at the end of the day, and spoiler alert, no, there was no value there. So anyway, I started doing the angel investing, kind of doing it wrong, but learning and getting lucky, which is, I'd rather be rich than right. So in that case, I did okay in those. And then along the way, when I was leaving my second startup, thinking about doing my third startup, this was luck, but prepared luck. I fell in with a company called Dreamit Ventures. Now I say it's prepared luck because this time I was smart in that I didn't put my head down and just focus on the startup. I was also allocating time to building my brand. So I had started writing for a publication called Alley Watch, which was originally New York-based tech scene. Now they cover a whole bunch of cities. And at the time, there was nobody writing about angel investors. So I had the editor-in-chief say, "Andrew, I want you to write for Alley Watch." And in one of the few smart things I've ever done, knowing it was smart at the time, instead of saying, "Hey, Bonnie, man, Bonnie, I got a real job, right? I don't have time to write content for you for free." I said, "Let me think about it." So I ultimately ended up doing interviews with other angel investors, put it in a semi-structured form, and I would publish that every month through Allywatch would publish it under my name. And it was a good way for me to get to know and stay in front of a lot of angel investors. It was good connections for me to have, and it wasn't that much work. So with that as background, when Dreamit was looking for somebody to take over the New York office, and they wanted people with good networks who had done startups before, and that who had an interest in investing. There are a number of people out there who fit that bill, and I know the two other people that were looking for the same job when I was, but I could point to that series of articles as a demonstrable proof of my network in the early stage investors. So it kind of gave me that leg up. So when they were looking, like, oh, let's bring Andrew in. So that was prepared luck, for lack of a better word.
And how important, Andrew, is network?
Critically. I mean, at this point in my career, it's all about network. So I can give you like 1,001 examples, but let's start with something that, your audience cares about, right? We talked about exits. If we have exits, you have to raise the money to actually get there. So for fundraising, like, it's become a little bit more accepted to go out there and try to like spray and pray your way to funding. By accepted, I mean, people are telling you to do it. I don't mean it's effective. I'll give you an interesting analogy. You were doing high touch sales at the agency, right?
Mm-hmm.
How, on average, like, what was the average contract value, if you don't mind my asking?
Sure. So when we first started, I would say the average contract value was anywhere between 150 to $250,000. And then as technologies change, that's probably come down now to maybe like 100 to maybe like 100 to 150 for a phase one.
Okay, let's just call it 100 to make the math easy. I'm a big fan of making the math easy. Before you reached out to anyone to pitch your work, you researched the heck out of the company. You researched enough to figure out who the right person in the company is for you to be approaching. Then you researched the heck out of him or her. Then, ideally, you got a warm intro to that person. And if you couldn't get a warm intro, God forbid you couldn't, you constructed laboriously a very personalized email that in the first sentence or two jumped out at this person and let them know that you knew exactly what their pain was and how you could solve it. So before you reached out to that one person, there were hours of work into that one outreach. Am I right?
Yeah, absolutely.
Okay. So instead, founders who are now not raising 100,000, they're raising 10 or 20 times that amount, think it's okay to reach out to an investor with a "Dear investor, why don't you do my pet intelligence startup?" which is not anything I do, right? They think it's okay to spray and pay with zero research, but I'm going to give them 10 times or 20 times the money. So,
and that probably just puts like a blacklist on their name or something, right?
That's funny you should say that, right? I've used this analogy in public, usually when I'm talking about my book. And, all of a sudden you see like a quarter of the audience like go pale, right? They're like, oh, crap, I just did that. And I say, don't worry if you've already done it. Truth is, we deleted it without reading it. We don't even remember you did it. So you have a clean slate to be right.
That's good. That's good news.
Yeah. So,
Yeah.
there's an opportunity to do it right. But like the right way to do it, remember, you're selling parts of your company. Right? So you want to treat it like the highest of enterprise sales, the highest touch of outreach.
Yeah, no, that's fair. Yeah, and I vaguely remember. So with one of our companies, which was Startup Wars, I was in the circuit for a short while, to do a fundraise. I was like, you know what, I should. We're teaching students about this. I should go through this process. And I remember either reading or watching some videos about startup funding and about pitching investors, and one of them definitely said, yeah, email as many as you can. And it sounds like, and with that exact kind of phrasing. And I remember getting no responses on that. And so I changed it and I got a slightly better response. But yeah, it sounds like, people shouldn't always listen to what
Yeah.
they hear just randomly.
Well, that's the difference now. When I first started, there was very little advice. If you could find it, it was actually reasonably good. Now we're drowning in advice, but there's a lot of posers. Um, but at the end of the day, it goes back to what we started talking about, which is building your network. It's absolutely critical because that's how you get those warm intros. Um, I can have a little bit of bonus advice for people whose networks aren't as strong. So
Yeah,
this is a
please.
hack. Unfortunately, I didn't have it in time for the book. Something that I've come up with later, so called bonus content. Uh, let's say you go through the entire process, right? You've gone through, here's 100 potential investors, and I talk about how to do that in the book. And you've gone through like your networks to figure out who can give you warm introductions to whom, and you're left with a couple of investors that you have no way to get in touch with them. So I used to say, okay, send them a cold email, but make sure it's like super targeted. And I would say that, and I know that it still didn't have a snowball's chance. But the hack that I now recommend is a little different. Don't cold email the investor. Cold email one or two of their portfolio companies. And the reasoning is this: the other founders, they're not deluged by random outreach from like, I want $1 million of your money. So they're getting a lot fewer of these. And at the same time, they were in your shoes not that long ago. So you could
They can
say,
relate.
hey, Jedidiah, listen, I'm thinking about approaching institutional venture partners for my Series A round. I see that they invested in your company. Can I talk to you for 20 minutes just to find out what they're like as investors? And
That's
you
a great
being,
idea.
you were in my shoes not that long ago, you're more likely to say, sure, come by. I got coffee in my office or whatever. Well, you'll sit down. And ideally, you've picked a company that has some commonalities with you, same industry. Maybe you could do business together. Hopefully, you hit it off. And by the end of that call, they may turn around and say, hey, Andrew, you know what? Would you like me to introduce you to, Bob? He's the guy that led our round. So like that cold email is more likely to actually get answered and lead to a warm intro to the actual investor.
That's genius. I actually really like that advice.
I
Thanks,
only wish
Andrew.
I'd had it 6 months ago. It would have been in the book, or a year ago would have been in the book.
Yeah. Yeah. Well, so I'm glad you mentioned the book. And we were just talking about, like kind of posers and people putting all this information out, some of which who have never actually created their own company, which is super freaking frustrating, right? And so you are a real founder. You've actually both failed and succeeded in two different ventures, right? And now you've been working as a VC, and you've also been working as an accelerator as well. If I understood that
Yeah.
right?
Yeah. I'll give you my quick bona fides, right? So after those two startups and in between working in a family office, doing some directs, at Dreamit, I made 71 investments over the 7 years I was there. And since leaving, I've done 7 additional investments in SPVs, or just one-off investments that I've done with friends. And as part of that whole accelerator process, like to get a cohort of 12 startups when we were really, really early stage, I looked at, I kid you not, over 1,000 startups in a 2-month period. So,
Wow.
and I would do that repeatedly. As we went a little later stage, I would only look at a couple of hundred because they were further along. But, I had to learn, like, okay, angel investments, that's great. I got this really cool idea. That's interesting. Okay, I can put the money in or not. That's a
Yeah.
whole different ball game than in 6 weeks, I need to have 12 really good startups that I'm going to put through a program at the same time. It's going from like Etsy to, Ford Motor Company level production.
Wow. Wow. So, all right. So it's been over 70. So if I heard you right, you have made over 70 investments, 70 different, and like, are they all different industries? Did you niche into a single industry?
So I am now, right? So when I started, the first 5 angel investments I made before Dream, all over the board. Then my first 24 at Dreamit, we were a pre-seed stage, meaning usually first money in, very often pre-revenue generalists. So those are also all across the board. Then for a brief period of a little over a year, I focused on ed tech, and we did 17 investments in ed tech. I built up that vertical for Dreamit. Then, longer story, we found an opportunity to get into what we called urban tech. So PropTech, real estate related technologies. and construction tech. And I made 31 investments in that vertical. And that's really where I play now. I'm very comfortable with business to business startups in general. And I know the space and the other investors really, really well in those two sectors.
It's called PropTech, you said?
PropTech, like property.
Oh, PropTech. Gotcha.
Yeah. Crop tech, in theory, could be ag tech, but they call it
yeah,
ag.
that's okay. Gotcha. Yeah, that's what I thought you said, but I misheard. All right, so PropTech. And just out of curiosity, kind of unrelated, but how are the ed tech companies doing? Because I know there's a lot of stuff happening with the government and education and higher education. Are you seeing any trends along those lines?
Yeah, so I've been out for many years. Like
okay.
I switched 2017. I switched to the other industries. I still have one or two that are doing well, right? I mean, I'd love them to exit, but they're doing very well, and they should, knock wood, very well. A bunch of the others have exited. Most of the others are no more, or they're kind of like, they're still clicking along. But after close to 10 years, a company that's clicking along, growing at 10, 20% a year, that's not a win for a VC. It may be for the founders, but it's not as fast as we would have hoped.
And so, okay, so for startup founders who are looking to, raise funds, what are some quick things that you could recommend to them to do based upon your experience as the VC?
You know where I'm going to go now.
Probably the book.
Read the last 6 chapters of the book. It's about the fundraising chapter. Sorry. Well, I have to say that. Like, a publisher will smack me if I don't. But that's the truth is, the book is all the advice that I've given all the startups that I've worked with over the years, condensed and put into a fictional novel format. Right. So the idea behind it is it should be your one-stop shop. You shouldn't have to go and stitch together, this blog entry and that blog entry and this video. You shouldn't have to go and like wander through maybe really great content, but like horribly written business book prose that makes your eyes glaze over. This is an attempt to pull it all into one place. So, it's pretty much all in the book, but I'll give the less wussy answer, right? So if you're going to raise money, right, that was the original question, right?
Yeah.
It starts with getting 150 to 100 plus potential investors that make sense for you. Now, I say relevant investors. What that means is you should be able to say, hey, Jedidiah, I see that your buddy Bob at Insight Venture Partners, I see he is invested in companies A, B, and C. And since I'm building this, I think it would make sense for him. And that sentence has to make sense, right? It can't be like, oh, I see he invested in Uber and Lyft. I have this, pet walking startup. Well, that makes no sense. But if it was like, oh, I see he invested in Uber and Lyft. I have this scooter share called Lime. Well, that kind of makes sense, right? It's same, but different. So you want to have a list of ideally 100 plus investors where that, you invested in these things. So you might want to invest in mine, similar business model, similar industry, whatever the case may be, makes sense. If you don't have that many prospects in the top of your funnel, you're not going to get to the point where you have enough interest at the bottom that hopefully you have a competitive round.
I take it when you say that, similar businesses, I take it you don't mean similar enough where they're competitors.
Yeah, so that always comes up. The truth in many cases is founders will overestimate the extent to which companies are competitive to them. Right? So the acid test here is the customer that you're targeting. Would they ever realistically buy both of your products? If the answer is yes, don't worry about it. Like later, you could all become anything you want. But for now, like the investors that would invest in you would have no conflict over who they want to recommend if a customer said, who should I use for this? So I'd start with that. And there's a whole art to dealing with when there might be portfolio conflicts. That's a longer conversation. But if step 1 is coming up with your prospects, filling the very top of the funnel, step 2 is figuring out how you get that warm intro that we talked about. And there's a process for going through it and optimizing, like, who do I ask for what? How do I give them an easy out if I think they might not want to make that intro, or if I just think they lost my email? So there's a whole process for matching up the 100 plus investors you want with the people who can make the introductions for you, and then actually getting those intro requests out the door and following up. And then when you actually get to, you get interests, now you're a little further down in your sales funnel, your investment funnel. Then there's how you run those meetings, what goes into your pitch deck that you present to them. And ultimately, when you get to the point where you've got interest from at least one VC who's given you a term sheet, how you try to parlay that into a couple of other term sheets, and how you can use that to finally have a little bit of leverage in the process and maybe get the best terms you can for your startup.
And question for you. I know a lot of startups are asked when they're applying for funding, they're asked to give a 5-year projection, right? And a lot of that, it seems to me, is really just guesswork. How would you suggest that founders approach that, and how do VCs look at that?
Sure. So it depends on what we're looking at. So the financials that you have at the back of your seed stage deck that says, here's where we're going to be in 5 years. I know one thing and one thing only about those financials. You want to guess what that is?
They're wrong.
Bingo, right? I know they're wrong. So, but I'll tell you why I want to see them. At that stage, I want to see them because I want to make sure that they are plausible for a venture-backed startup. So I'll tell you what I mean by that.
Okay.
So if they have a 5-year financials, and the end of 5 years, they're at like $2 million, they're not growing at a pace that is venture backable. It doesn't make sense for me to get involved. If in year 2, they're at 100 million, they probably get really good drugs, right? It's unrealistic. So if I'm like the stereotypical, like I invest in software startups, and I do more than just software, but if you're just software startups, you're kind of looking for startups over the first couple of years will double or triple those first couple of years. Those are reasonable growth rates for very successful startups. Now, I'll put a caveat on it. The latest crop of AI-based companies, some of them have been super scalers, growing like 10x a year. I don't know if that will continue in the future, or if that's just an artifact of where we are in the cycle, or if that's a phase change. But we'll mention that and move on. But the point of the financials at that level, because you're not putting all the detail in it, you're just showing me top level stuff, is that it looks plausible, right? And you have some high level stuff, like you might put like your costs for the number of customers, and I can do like basic math. Oh, it's X dollars per customer. That's really what I'm looking for at that stage. If I buy everything else about the startup and I'm really ready to dig in, I will want the actual spreadsheets. Now,
gotcha.
I save that for last because that is an epic amount of work, and I want to do that last because I'm lazy. And I've got a lot of startups to look at, and it's like, okay.
Yeah.
Now,
do you do it now, or do you have AI do it?
No, I still do it.
Okay.
There's other stuff I'll do by AI, but what I'm really trying to understand with the spreadsheets, again, is not as it's right or not, but I want to understand how the founder thinks about their business. And in an ideal world, what I'm seeing are numbers that are driven by decisions that they make and governed by reasonable assumptions. So I'll break that down. What I don't want to see is the revenue at the top line. February equals January times 1.05. Like they're hard coding the growth in there. That doesn't tell me anything. That's like, how are you doing that? On the other hand, if like you're a business to business startup, I might want to see something like, okay, your revenue in March is your February revenue plus the new revenue, and the new revenue, it's your March revenue minus churn, right? Plus new revenue. And I want to know what your churn assumption is. Does it make sense? Okay, that's plausible. If it's high, I want to know why. But then for your new revenue, your new revenue could be based off of, I hired new sales reps. I think each sales rep should be able to sell $10,000 of software a month, whatever the case may be. It takes them 2 months to ramp up, right? I want to see that you've thought about how these things are driven. And if it's like a consumer related startup, it might be driven off of Facebook or Google ads, right? I'm going to put this much money into ad buys. Is this much click-through rates? There's going to be these many people pogo sticking out. There's going to be these many people putting things in carts. It's an average amount per cart. This number of people actually consummate and finish the sale. Like I want to see those numbers. And then I want to be able to play with those numbers and see, um, what's really, where the sensitivities? Because some numbers I could be off by 50%. It doesn't make a big difference. Some of them, if I'm off by 1% or 2, I don't have a business. So I want to make sure that like I know what those are. And most importantly, I want to make sure the founder knows what those are. So when I'm digging into the spreadsheet, I'm trying to understand how well the founder knows his business.
Gotcha. And so it sounds like for anyone to really have a chance even at getting this funding, they really need to have a substantial amount of data that they can pull from operating their business up to date so that they can even make these projections.
So it depends on where they are in the business, right? So earliest on, you don't have data to base it on. You're making certain assumptions. But I want to see that the assumptions are plausible. And I want to see that you understand what you're sensitive to. So if it is let's say e-commerce, right? You're selling something, right? Now you may be selling something that's different from something else, but it's close enough that like I'm selling like a super hairbrush, right? Okay, well, what's it cost to bid on keywords in that space? I want to make sure that you look that up, or maybe even better, maybe you created like a BS like Squarespace site and you've actually bid on keywords, right? You said, listen, I put $100 down. Here are the campaigns I've run. Here's what my cost per click is. I did that just to prove my assumption, right? I want to see that they've gone as far as they can to test the critical assumptions before they ask for my money. So A, they need to understand what those assumptions are because they've modeled their business. B, they've tried to research them as much as possible. And if they can, test it as much as possible. Now, they won't have 3 years of data to base it on, but they can show me everything they've done to date to make those things less of an assumption and more of a proved input.
Gotcha. I think that makes a lot of sense. So, all right. So I know we're coming up on time here, but I really want to know, you have created multiple companies. You've invested in over 70. So when you wrote this book, The Entrepreneur's Odyssey, you wrote it from a period of experience, from, a perspective of experience.
I hope.
Yeah, it seems like it. I mean, from this conversation we've had today, like I can definitely tell that, you're not a phony who, just wrote a book to sell it. You wrote a book with your experience and the experience of 70 plus companies that you've invested in as well. Can you walk us through just what the book is from like a high level, start to finish?
Sure. Happy to do it. So I used to describe it one way, and I have a friend who does very high level PR, and he gave me this other way to describe it. And damn it, his is a much better way to do it.
Okay, let's hear it.
It's good. It's his job. He says it's lean startup meets The Alchemist. So the reason that tends to work is it gets across the fact that it's written like a novel. So it reads like a work of fiction. And it's about a fictional startup, which is loosely based on a startup that I've been working on the side in the call recording space. It's a privacy-centric call recording app and transcription app. It starts with the founder, Marcus, in an evening pitch event sponsored by a law firm. And if you've been in our field long enough, you know exactly what those look like, with 3 mostly junior VCs judging it, and all the entrepreneurs and the hangers on in that audience. He gets up there and gives a very kind of awkward, nervous pitch. But one of the investors was a last minute fill-in, who was an angel investor, kind of crotchety and cranky older guy, partly based on me, but partly based on somebody else entirely, ends up seeing something in it that he likes and ends up taking Marcus under his wing and mentoring him through the process of taking this from, partly built, more idea than code, all the way through to closing his first round of financing.
Wow. Okay. And you said it's written like from a narrative, like fiction-based narrative perspective. So almost like maybe like built to sell style. Have you read that one?
So I haven't, but the book called The Goal was my model. Like, I had read a book called The Goal in business school. It was a fictionalized version of a guy who had to turn around a printing plant in the Midwest, but it was de facto strategy and operations textbook. So I used to describe it as The Goal, but for startups. But since, if you didn't go to business school in the 90s, you don't remember The Goal. That wasn't as effective as Lean Startup means The Alchemist.
Yeah, well, I love that about the Entrepreneur's Odyssey, and
Yeah.
here's why. When I switched my company, right, from the Web Junta, which was my first agency, and then I took over operations. I bought my co-founder out, and everything was now mine under OpenForge. I felt a little jaded. I just went through a co-founder divorce, and so I needed some personal time. And so a friend of mine recommended the book Built to Sell, which is how to turn an agency into like a sellable business. And because it was written from a narrative perspective, it was more of a storytelling. I was able to buy my entire team a copy of the book. And we had a book club. And I said, hey, everyone, you know, I still want to do this, but as a founder, I need to grow too, and I need to change what I'm doing. And this book describes the model to take. And so I bought everyone a copy of the book. They all read it. And even though they weren't founders, like they were team members who've been with us for years, they understood it because it was written in that perspective. And so I'm really excited to read The Entrepreneur's Odyssey now, because it could be a thing that I could use even for my team. Because now that we've grown, we have a parent company, and we have 3 companies under that. And I'm now facing new challenges, new hurdles, where my team that was perfect for the one company is struggling when it comes to a different perspective from another company, because it's different challenges. And so I've been looking at like new ways to kind of educate my team on thinking like an entrepreneur, and thinking about the entrepreneur's journey and mindset. So maybe this book could be a solution.
So actually, that reminded me of two things. So the idea of actually having a book club, or whatever you want to call it, in startups is not that crazy. I know a couple of companies that do it. And the one that I'm sure most of at least your tech founder people out there are recognized is Carta. They actually give all employees a little monthly stipend to buy a book. Something, I believe it has to be something professional, but the idea is like, you buy it, you can expense it. They want their employees reading and growing. So it's actually not a crazy thing at all. It's some of the better companies have operationalized it. The other thing, which it seems like you got intuitively, uh, people remember stories better. Like, I used to give the same advice when I was running the accelerator. I was like, here's what I think you should do. Or I would say, hey, this is other company, this was their situation. And like, this is how they turned out. And it always stuck when it was a peer company, that it was their lived experience. So I try to translate that, instead of like stitching together like 13 different companies with different lessons, into one simple overarching soup to nuts, storyline about the same startup, just for consistency and for, I think, just readability. But that's what's, by the way, this is also the reason that every religion is formed on a book that's a story. No religions that we know start with, here's your 10 commandments, go and run with them, right? They all start with a creation story, a founder's journey, right? They all start with the often colorful individuals and their life, and how they came to be where they are to give these laws. It's not by coincidence.
That's an interesting point. You're
Not,
right.
not that my book
Yeah.
is on that level, just to be totally clear.
Yeah.
It's a good book,
Yeah.
but it's not the good book.
Yeah. A hero's journey. Oh, that's cool. All right. So then let me ask you, right? So if someone reads this book, right, where would it take them as a founder? Like what can a founder expect to get out of the Entrepreneur's Odyssey?
So there's actually a couple of different people who I think should read it. And we'll start with the earliest ones. The people who are sitting in their office or in their cubicle, banging their head against the wall a little bit, thinking, there's got to be a better way to do this, because it's a painful problem to deal with all the time. And the light bulb goes off, oh, I think I could solve it this way. And they've done a little bit of the research. They don't see it out there anywhere. And they're thinking, do I leave the relative security of a corporate job into the unknown of being a founder? And what does that actually mean? And that's part of the reason. Another part of the reason I wrote it as a novel was, you don't get the feeling for what it's like to be a founder, for what it's like to see, your bank balance go down every month because you're paying yourself until you can get funding. What it's like day to day, kind of lonely, right? Kind of not sure what you're doing, kind of figuring it out as you go along. You don't get the flavor of that from the kind of the bland how-to books, nor from the kind of glamorized Steve Jobs biopic style, like startup stuff. So for a person in your audience who's thinking about maybe they want to take that plunge, I say they have to read this not only for the skills that it'll give them, but also for the feel, like, is this for them? Is this the right decision for them at this point in their life? Now, for the founders who are actively building a startup, read it as soon as you can, right? Because I made a ton of mistakes. The only virtue in the mistakes that I made when I was building my first startup was they didn't kill the startup. So, learn from other people's mistakes if you can. The sooner the better. And then last but not least, right, if your mom's on your case for like, when are you going to get a real job, buy her the book, and now she'll know exactly what you actually do.
Okay, that's a good one, especially as Christmas is coming up, and Hanukkah and the holidays, right?
I just bought a copy from my buddy Irving. He's 101 years old. He's like, what is it you actually do? I'm like, let me send you a book.
Yeah, and maybe for spouses too. I know when my wife, when we first started dating, she had never, been with an entrepreneur before, or anyone who like ran a business, and it was a big transition, and it took years for her to really figure out like, what this lifestyle is like, because it's not a 9 to 5. And if you're a founder coming into it thinking it's going to be a 9 to 5, or that you're going to succeed after 1 year, think again.
It helps if she has the stable job and you can get your health care through that, and you have
Yes.
that as a basis. But
That's what we do. She's a nurse. And so, yeah, healthcare is through her. All the risks are through me.
in some ways, like, your spouse is your first sale. Before you try to sell a co-founder to bring him or her in, before you try to sell an investor, before you try to sell a customer, you got to sell your spouse. You can't do that alone. They have to buy in.
That is a hell of a quote. We're going to put that in the very front. Your spouse is your first sale.
Yeah. I used to say your co-founder is your first sale, but you're right. Your spouse is really your first sale.
Yeah. Wow. This has been amazing, Andrew. I have one last question for you. Is there any advice that you've heard people give founders that you think is absolutely bullshit?
Tam, Sam, Sam. If you could find the person who came up with that idea, I would pay you good money just to smack him around a little bit.
Why is that?
So your total addressable market is one number. That's your total, right? The problem with your serviceable addressable and your serviceable obtainable market is no one knows what they are. If you line up 5 investors and say, write down on a piece of paper the definition of those two things, I will bet you 100 to 1, not one of them will have the same definition as the others. So no one knows what they mean. So if I see a Tam, Sam, Sam slide, I know with absolute certainty that 2 of the numbers, and maybe all 3, are wrong. And I don't know which one, right? The TAM could be some ridiculously large top-down number that has nothing to do with what you do, so that's wrong. And maybe your SAM is the right one, and then your SOM is, I don't know what the hell, right? Maybe your SOM should be your go-to-market. Like, we're going to start with this segment, if I'm lucky. So then 1.5 of them are wrong. Or like they could just all be wrong. Or maybe your TAM's right and everything else is BS and the bottom numbers. And then if we only get 10% of the market, like, yeah, good luck. 10% of the market is hard. And that's 10% is not T total, right? So totally wrong. Your total addressable market is very, very simple. It is, what are the total number of customers that might possibly buy what you're selling times what you charge. A times B equals C. It's 4th grade math. It's that simple.
I wish I had that advice when we first started Startup Wars, because when we started it, we were going originally consumer, then COVID hit.
Mm-hmm.
And so all these instructors started reaching out to us. And so we pivoted into the higher education market, right? Mostly because, hey, we saw an opportunity, all of a sudden all colleges were shut down, right? Yeah. So we said, okay, this is great. And then, when we started doing, when that landed and instructors and the students said, hey, this is awesome, people can experience different types of businesses, like, we want to buy this. We said, okay, let's expand this. Let's scale it. And we thought that higher ed was going to be our end all be all. And so we started cold emailing. And then I realized there's only 10,000 business instructors in the United States. We actually emailed all of them within like a single month. And I
Can
was
I
like,
borrow
oh,
your list? I need to pitch the book.
yeah, yeah, you can actually. Yeah. And actually, funny you say that. So we did it the approach of not built to sell. What is it? Predictable revenue, where
Mhm.
we hired first like a person whose whole job was just to make a lead list, and then we
Mhm.
afterwards we hired a person whose whole job was just to call or email those
Yep.
people.
To pre-qualify.
And yep. And the process was fine, but this it took time, and it took a month or two just to get through a couple states. And so I was like, this is way too slow. Then I found a service, I think it's called like K12.org or something like that, where I just bought it for $1,000, the entire list. And I was like, oh my
Yeah.
God, such a better process, right? And so, it's again,
So
the
there are
reason we,
there is time. There is a time where cold emails do make sense, but it's not for fundraising.
yeah, of course, right. And yeah, so I wish I read a book like Entrepreneur's Odyssey before going through that process, because the more you can learn as a founder to just understand the stuff that you haven't experienced yet that might help you, the better. So
Yeah,
I'm very
I would
excited.
hope so. I would hope so.
Awesome. Well, Andrew, thank you so much for joining us today. I definitely appreciate it. And a question for you: if anyone wants to contact you from the audience, what's the best way to get a hold of you?
Um, the best way to do it is you start off, go to my website. It's Andrew B as in boy Ackerman .com. Sorry, I should have said that. So they can just go there and find out a little bit more about me. My email address should be on that. If you do reach out to me, just be very, very clear in the subject line what it's about. So it could be, founders that build / questions about whatever. Just put it in the subject line. At least I'll know that you heard about me on Founders That Build, and I'll know that you're just not some random dental hygienists reaching out from like Cleveland to, I don't know, link to me on LinkedIn for no reason.
Yeah, you probably get a lot of those, right?
Yeah, there's a reason I use that as an example.
And for the book, for Entrepreneur's Odyssey, where can they buy it if they want to get a copy?
Um, Amazon's probably the best way to do it. All right, it's always on it. I will say that if they get on it, there's the one with this lovely maze themed cover. Like there's a guy with a chainsaw hacking the maze. There's also a hardcover that's designed just for libraries with a boring blue cover and a shockingly high price tag. Don't buy the hardcover. No one's supposed to.
Okay.
My mom did. I told her not to. But, this one, the one that looks nice like this, or the Kindle edition, you can buy them both on Amazon.
All right, awesome. That sounds great. So, Andrew, thank you so much. It's been a pleasure. And for everyone out there, thank you for listening. Please like and subscribe. Also, if you do purchase the Entrepreneur's Odyssey on Amazon, please make sure to give our friend Andrew Ackerman a glowing 5-star review. I'm pretty sure I can promote that for you, even if you can't ask for it explicitly. And stay tuned for other episodes. Again, this is Founders Who Build, and we like to make sure that we're interviewing real founders like Andrew here who have gone through all of the hell and the shit that you are going through or that you are soon to go through, but they've come out successfully on the end, and they have a lot of knowledge that they can share, and that's the purpose of this whole show. So, Andrew, thank you. Audience, thank you, and we will see you all soon.